let's talk about that in an environment that we're in now, where we're increasingly in agreement with even outsiders that the stock market is what it is, and that now we have these the weird stuff going on in interest rates. What are you looking at as far as portfolio management as well as investments overall, or maybe just trading ideas? Do you just kind of trade the short run and kind of wait it out, or what is it that you're seeing and what you're doing?
What I've tried to do, and I have gotten quite a bit better over the last year and a half or so, and I've tried to focus just in my own portfolio more on, and just instead of these, I used to just do something once every like 3 years. Like as an example, I wouldn't do anything until we had COVID, and then I go in and buy at the bottoms, but then I don't do anything for 5 years or something like that, just stay in T-bills or something, or in gold. And that worked okay. And I did well in real estate that way, but I wanted to be a little more proactive, just as an intellectual experience, an intellectual challenge, if nothing else. So one thing that I've noticed going back to this conversation is I do believe, and this is not me being arrogant or confident at all.
It just means it's going to come across that way.
No, because I'll be the first, I mean, you and I are very authentic, and we'll be the first person to tell you that we don't know that much, and we're just trying to figure this stuff out as well, and we make mistakes all the time. But it seems that anyone with the view of interest rates, that it's all about growth and inflation, as crazy as it sounds, to me, that's an edge. Because even with the hedge fund managers that I listen to, there's so few people that actually understand what drives rates or what drives the dollar, or at least all, or not all, because no one can know all, but the vast majority of the variables that drive the dollar or rates. So, but the problem with that is if you understand it, you say, okay, I've got an edge there for sure. But how do I express that in a way to make me money? Because as an example, most people that watch my channel, or a lot of people that watch your channel, they might be bearish, or they might hear some of the stuff that we've talked about in this video. So they just go, oh, well, I'll go buy puts on the S&P 500. No. That's not how you express the edge. Like, even if you understand that rates at the long end, or let's just say about growth and inflation expectations, going out and say, okay, well, I get the yield curve inverted. Now it's flattening out. That's a bad sign. Everything's going to blow up in AI. Everything's overvalued. So you go out and buy puts on NVIDIA. That's the quick way to the poorhouse, as Jim Rogers would always say, because you don't know the timing of that. So what I tried to do is take what I thought was an edge and figure out a strategy to actually make that actionable right now. Right. So what I did, which is, knock on wood, it's worked out really, really well. And I think also it might be the point in the cycle we're in. So I think that this strategy works at this point in the cycle, but at a different point in the cycle, it might not work. So I'm very open to that, and open to having to change and have more tools in the toolbox, so to speak. But what I did is I'm like, look, there's no way the S&P 500, it's wildly overvalued based on the economic conditions. I mean, we talked about the non-farm payrolls. The whole labor market sucks right now. Even if you look at ADP, it's horrific. And you've pointed out many times that just because the unemployment rate goes down, so what? If that means that there's 10 million people, I'm exaggerating, but 10 million people,
not quite that much,
that aren't working, right? That's not a good thing. I don't care what the unemployment rate is. So anyway, I'm bearish on the stock market, but because of passive flows, because, we might be in 1998, there's no way I want to take a directional bet. So what I do is I try to pick out stocks that I think are highly cyclical, that probably won't do well if, in fact, we're headed toward an economic contraction, regardless of whether that economic contraction is playing out in full effect now, as you say, the feces hitting the fan, or if that's going to happen in 6 months, or if it's even going to happen in a year. So and this isn't investing advice, I'm just telling your audience, some of the positions that I have. So for me, about 6 months ago, I was really bearish on housing. Because I'm like, well, wait a minute. If rates go up, that's not going to be great for housing because incomes haven't really gone up. But if rates go down, to your point, that's a reflection of the economy. And I don't know if that's great for housing, because that means likely the unemployment rate is actually going up in a material way, and people are losing jobs. The labor market's continuing to deteriorate, so people have less purchasing power. So I'm like, well, I don't like Lennar, but I don't want to take that outright directional bet. So what I do, just as an example, is I short $10,000 worth of Lennar, and then I take a long position in the S&P 500 of $10,000. Now, you want to, it gets a little tricky as far as the ratio. You shouldn't really do 1-to-1 if you want to be more precise. But that's just using an overall example. So I'm shorting something because of the yield curve, because of the point of the cycle we're in, because of all the things that you talk about on Eurodollar University. But to hedge that, the understanding that I don't know the timing at all, and we could be in 1998, to hedge that, I take an offsetting position in the S&P 500. And I every single time I've done that, Jeff, with all the companies I've done that with, for whatever reason, every single one has worked out. Literally every single one, I'm up pretty substantially on those positions. So that's kind of how I've taken what you talk about on Eurodollar University. Ask myself, how does this knowledge give me an edge? Because it absolutely does, that's for sure. But then how can I take that edge and turn it into something that's actionable, being realistic with myself, knowing that I know the end game, but I don't know the timing of it. And how do you just, increase, or how do you make investments in a way that the timing really doesn't matter as much?
Yeah, that makes a lot of sense too, because we both start with a high degree of understanding that uncertainty it's much bigger than people think.
Yeah, I'm sorry to cut you off, Jeff, but one thing
ahead.
I also wanted to add to the interest rates that makes it even more complex is you and I are sitting there, going through a very quick analysis, but what we're omitting right now, especially, is the elephant in the room, and this is geopolitics.
Yeah.
Right. And if you really want to narrow it down to something absurd, but unfortunately real, it really boils down to Trump's Twitter feed. Like seriously, that's going to move rates like more over the short run, because of oil. And right now, everything's a derivative of oil, even interest rates, right? It's one of these short-term fluctuations where, yes, it's about growth and inflation, but it's not really about maybe the labor market so much as it is just about the price of oil, even though that price of oil impacts the labor market.
Yeah, the way I look at that is it's a source of uncertainty. So it's a higher degree of uncertainty. Therefore, there's lots of more variation in even something like the interest rate. So we have short-run disagreements about what growth and inflation expectations are going to be because we don't know what the oil prices are going to be. At least we don't have a really good idea what oil prices are going to be 3 months from now.
So 3 minutes from now.
3 minutes.
Because we don't know what Trump's going to tweet about.
Hey, you got to give the guy credit because he has manipulated the oil price for nothing more than social media statements for months now. For months. So whatever you think of Trump, as far as that goes, it's been not just a wild ride, but a pretty good big success. From October 9th through 12th, I'm bringing together a group of roughly 40 serious investors and financial professionals, along with some special guests and friends like Hugh Hendry and Mike Green, George Gammon, Brent Johnson, and a couple of other ones, where we're going to spend 4 days asking the questions that truly matter. What happens next? Where are the biggest risks being mispriced? Where are the opportunities? What should change our minds? And how should we think about positioning around it? This is not a conference built around speeches. It's a small room built around discussion, some disagreement, and actionable advice. So if you manage some meaningful capital or you're seriously interested in all of these questions and finding answers to them in a very small, intimate setting, apply below.